Hey, good evening, guys. Ken at Tortoise Capital Nightly Strategy Podcast for October 22nd, 2021. Just a quick look. I just wanted to share with you. This is our creativity course sponsored by Leavenworth United Soccer Club. Has some guidance from our captains on life lessons from soccer, orientation, quick fundamentals of creativity, the process of creativity, generating creative ideas, developing those ideas, becoming more creative in everyday life, and then a review and some next steps. So pretty excited about that one. That's open right now. And it's the Creativity 101 is the prerequisite for taking Creativity 202 for traders, where I take Professor Fletcher's work on creativity and the handbook that he wrote for us, 30 modules of lessons for military leaders to become more creative in our decision making. An amazing piece of work. I'm teaching an elective course on that already for applied creativity. And with his permission, I'm going to write a compendium or another volume that takes those lessons from his field book and turn that into 30 modules for traders. So we're pretty excited about that project. So I just wanted to share that with you. That one's up and running, self-paced. You can knock it out in 1 or 2 weeks if you got after it, and it will definitely help you. Let's see where we're at here. Let me get this. If you've never studied the work of Marina Abramovich, you ought to. Boy, does she do some interesting things with mindfulness and presence. Absolutely fascinating. Maria Abramovich, the artist. I can strongly recommend her work. All right, let's see what we have for today. Start with the market health check in the usual way. So we've had that big sell-off about 30 days ago. One leg, 2 legs down. Notice that was fall and into the winter for that second leg down. The RL10 bottomed out. The dragon turned right here. When you see the after that harsh winter, and then the P1 happens here, and then the RLXD, then you wait for the dragon to turn and the slope of the 30 to turn. That gives you an owl entry right here with a stop at the bottom of the dragon, and that's an owl trade. Those are the 5 criteria. That's what it looks like right by the numbers. And we've spent a lot of time talking about the SSC and should I get it here or should I get it there, or where do I get it? There's an argument for the owl, which just says, just be patient, wait for everything to turn, wait for the dragon to start turning up, wait for the RL30 to turn up, then buy that with a stop here, and it gets you out of all this kind of premature shenanigans. Yeah, you might lose a little bit on the opportunity costs on the early pieces, but if there was a significant enough sell-off, the owl entry with a reasonably tight stop here and not down to the piece, but at the southern skin of the dragon, you get an amazing trade. That's almost 3R. So there's a lot to say for the slightly more patient approach of the owl. That's a second generation RLCO pattern. All right, let's see what else we got here. So the winter turned to spring, turned to summer right here. And now we have broken above the previous 30-day high, which was here. We've made a new 30-day high right there, a new 10-day high, a new all-time high at 450, 470. Yeah, it closed back a little bit, but that's still pretty good. I'm concerned always about risk reward. And so I see that as a doji, and I'm ready to trade that intraday with about a dollar risk. That's 1/4%. So if I can get short around 452.50 or long at 453.50, I'm happy, and I can play it in either direction. We've got, so I'm interested in the long especially interested in the long from there, because it's breaking to an all-time new high, right? So I like that. The short side trade, I'm ready to get here. I would probably get my second entry at a break of about 451 as soon as it breaks below that 2-bar low, which is yesterday's low, because now it just feels like this whole that whole price structure right there would be failing if it broke below 451. And then a second position, if that didn't hold, I'd try to get my third position right there, which is also right by the top skin of the river. So here's the edge of the Bollinger Band River. And so that feels like a really important support level right around 448, which is also basically at the edge of the dragon, spine of the dragon. Lower skin of the dragon is right at the Bollinger Band main, which 440, which would be the target for any of those, any short side targets. I think got to be looking for 440 as a reasonable target, and that's halfway down the stack to the belly of the dragon at 432. So that's kind of the price structure that I see in place. I noticed that the RL270 is still long and strong. And says, what was the worry? I mean, what this little sell-off right here, which was almost a 5% sell-off from that previous high, that barely made the RL270 even flinch. But this actually sets up, when you look at this price level down here, that was the lowest peak of the RL10. So that sets up this move. Let me draw that as a great big purple opportunity. That divergence we think of as the regression line fractal framework that you have at this moment here, right? You had the RL270 and the RL10 both in perfect agreement as to what the favorable price or the correct price was. And then price with the RL10 sells off harshly, and the RL270 just keeps going. And then after this peak to the downside, you get the recovery move up to here. Now, it still has a little bit more to go to catch back up to the RL270, but that's why that's a target for us on the upside. So we call that phenomenon of that maximum excursion of the RL10 away from the RL270. We call that a regression line fractal framework, because that pull away from the long-term fair value creates an opportunity for a reversion to long-term fair value. And so we can actually conceptually start measuring. We can start measuring this move in blocks. Pick a block, an ATR or a standard deviation, the width of the river or something like that. And now what you can do is, as you start estimating what those moves are, you say, well, heck, there's a potential 5-to-1 move. And then you take that, you take that entry of the owl and you say, well, there's my owl entry. And lo and behold, almost to scale, I didn't do that intentionally, but there it was, right to the bottom of the dragon, or the lower skin of the dragon. And you have a perfectly framed regression line fractal framework trade. And you use the RL270 and that previous peak of the RL10 as the reasonable price target back to the upside. And now that we're there, now it becomes interesting to see what kind of follow through there might be. So this was just recovering the ground that was lost during the sell-off. So that's today's lesson, regression line, fractal framework. Awesome. Let's take a quick look at a couple trades from the gang today. Boys are doing some good crosstalk in the room again today. Well done. Here is a CLF. Let's see, is this? This looks like Ken H. Yeah. You start recognizing the style of the markup after a while. So he had some other things going on today. So he was on a 3-minute chart rather than his usual 1 minute. So he framed this on the daily. And what we had was the harsh sell-off from 26 down to find support at 20. It had one move up, one pull back, and now is starting this move again. So that feels like a Kata 2 on the daily. And then here's the, the gap opening and whatnot. And notice the size of the risk box. He measures the move from Z3 to Z3 when the market is sideways at the previous day and says, that's the size of the noise box when it's just chunking along. So then he takes that and brings it up into here. And it's a gap up in a mover that has a long way to go to get back to 26. So he just buys it and it runs up. This was a logical place to add a second position because it held like a Kata 2, didn't even get through the dragon. And he buys the second position, rolls over. I might have taken this one instead of that one. He just takes the sniper exit. It's still in the money. The Uwe exit gives him, that's this exit. That's 5R, just using the Bollinger Band mean. And he takes the sniper exit here. He re-enters and then it fails. So he just cuts it for -1, which was really the +1 that he earned here. So that's just kind of a wash. And the Uwe exit just crushes it with a 5R, a scratch. There was an SSC and a Kata 2 possibility right here. Late entry, scratch. Okay. He had other things going on. So on a day when he's trading on a much slower time frame, 6R, nicely done. Fisher and Paykel HE. I have no idea who these guys are. This, I think, is a New Zealand play. So I look at this one and I see, so we're going to evaluate a swing. This looks like a swing frame. And I'm noticing this support level is strong. Let's see. Richard asks, when the market moves sideways in the noise box, do you trade in this area? No. That's Crocodile River. That's normal behavior, is sideways choppy. That's where you get eaten. So I wait for a Z3 pinch breakout. So this looks like an important price level. The last move was this move, a high, a lower high. There's a lower low. That makes this break. That was a possible short. And now that gives us a harsh winter in here. Harsh winter. And now the RL10 bottoms out. It crosses the 30. There's a P1. There's the RLXD. There's the turn of the dragon and the turn of the RL30. That's an owl entry with a stop right there. And there's 2 units of reward. Is it reasonable that it could get back to that price level? Sure, it just has to go up and touch the previous support level or resistance level, and it's even below Z2 and Z3. So that's a perfectly constructed trade frame and a great entry. This is where I'd be looking at adding a second position, either the breakout of the peak of the dragon or the breakout of the peak of the RL10. So somewhere up in this area, you can be thinking about a second position, because now you would have had 1, 2 units of reward in hand with momentum. You could think about a second position up in there. NVIDIA, beauty. Important support level, a higher support level, right? So you bring this over. That's a plus. So that makes this a kata 2. You can also see the rollover has occurred. And then support level here, he buys the RLXD. You could have a stop here at the bottom of the dragon, or the stop at the PSAR flip, which is fine, which is where he's got it. And then here and here, that's the 1 and 2 units of reward. And that is still below the peak RL10. So that's not an unreasonable price level. It's right up here by the Z2 and it's below the Z3. I would be looking maybe at a second position right up in here, because it will have cleared all the resistance overhead. And this one, now on this, it's like 5 bars in, and today was a bit of a sell. I'm not ashamed to admit, I don't mind taking that and make bank. Get paid. I'm not going to let it go back below here, because you were at 1.5 on the maximum favorable excursion. You've already given back 1/2. So if I don't take that exit in here, I'm not going to let it go below about 218. Maybe I'd preserve. Maybe I just use the 1 hour stop of 219.60. Lock in 1. Get paid. Because all this is doing is rolling over where it rolled over before. Here's where all the resistance was. It's rolling over right where all the resistance was. You going to stick around for that kind of a move? No. Get paid. And then if it takes off, you know how to re-enter. Get paid. Don't lose money. All right, here's another one in Cliff on the 1 minute. There's that pinch box again. There's the wrist box. Enters after the gap and after it clears this noise, and it's above the VWAP, which is rising all day. He takes the entry, it rolls over, he scratches, gets the re-entry beautifully done. All of these gains. Oh, beauty. So first position, second position when it's cleared the Z2 and is still going. Third position when it clears the Z2. Fourth position when it's 1, 2, 3, 4, 5 R in hand. So the first one, on this exit, which is a perfect sniper. This would be the managerial exit. So the managerial exit follows the Bollinger Band mean all the way up. And that's 6.7. Had to step away. Otherwise, there's a perfect short and another short. So this thing was trading all the way good. So that's what 6 or 7R looks like. So here's a trading lesson for today. You have a stock that fired on the daily chart. You have a gap up. So in here you have a positive gap. And there was the open. It ran up this high, ran down this far, reverses. Here's the VWAP, and the VWAP is rising. Pardon me. Buy it with the stop just below the low of the day. And then at +2, you might have an automatically check to see if I want a second position or a third position. Excuse me. Be ready to stop and reverse if it makes a new low of the day, and I'm looking for it to fill the gap where I'll add a second position to the downside. By that time, where do I need to have my stop? Well, if I had it here, if I just use the PSAR dots, oops, sorry. Then I'm trailing that kind of a stop. If I'm using the Bollinger Band mean, I'm looking like this. If I want to lock even more in, I might just right here, just get my second position to no lose plus dinner for 2, something like that. So choose your exits. If I'm using the PSAR dot, and I'm still here. If I'm using the Bollinger Band mean, I have to adjust that a little bit. Something like that. On this one, I might now move my stop to here until the moving stops pick up. That way I'm locking in most of this gain, right? Third position. Now, at this point, I'm already going to just move that stop to no lose plus dinner for 2. I can continue the PSAR dot exit like that. The Bollinger Band mean is going to be something like that. And then all I'm going to do is just keep following price up and sliding this up and tucking it underneath those price bars as I go. And then I don't care where it gets me out. I'm in a science project here. Ooh, oh, bingo. There's a sniper. There's the PSAR. There's the managerial exit. Here's the VWAP and the RL 270, the fair value. So if you want to get short here, your target is going to be down here. at the purple dot. That's a return to fair value. You can't be surprised if it does that. That's what the definition of fair value is. Gets to the VWAP, gets down to the RL270 and fails to the rest of the day. And that's the story of Cliff. So there was a Kata 2 right in there and another one there. And this one's a good entry because it's in a Kata 2 and it's getting ready to fail below the 270 or below the VWAP, excuse me. All right. Nice work from the team today. Cliff was very instructive. We'll shift to the weekend report now. KH asked, in what case would I just intraday trade and not take a short swing position? The way this market is testing right now, the upside, I just think that there's a lot of money been lost trying to short the S&P on a swing. And to me, 80% of the time when I'm swing trading, it's just intraday anyway, because I don't feel like I need to take the overnight risk on the swing. It's just, it's too vulnerable. There's 16 hours when news can change. And the tempting time to swing trade is when things are panicking. Well, it's when things are abnormally panicking, when the market is closed, that guys get together and push the buy button on the plunge protection team and get crushed on a gap the next day, which can make that really painful. So I'm not so interested in shorting the S&P because it's such a target for long side manipulation in my worldview. So what I will do on a swing trade is when the S&P is in that kind of downward trend. It's not in a downward trend. That darn thing is bullish normal. There's no reason to be shorting a market in bullish normal. So I'll just intraday short side. There are other symbols, however, that are weak, that are below their 200-day moving average, like all the globals. So that's where I'll be swing trading short. I don't want to go short the strongest index in the world right now. I want to go short the weakest index. So as we go through here, let's see if we can't see some candidates in the ETFs for things that we might want to get short on. The only thing that makes me ready to be short is just how extreme this risk Z is, getting up here about 1.5. This is a natural time for it to start gaining some volatility, because you see the last time that it was there, this was a great short in the fall and then into the winter, in the same way that this was a great swing. So that was a great short. And then this one, God dang it. This move in the risk Z, when it turned over into the spring, went up through the summer, that was a great time to be long. And this was a great time to be short. And starting right about here, this has been a really good long swing. So I want to find the weakest index. This is not a weak market in the S&P. I mean, this thing is bullish normal. It's overbought everywhere, and even the 2-day is pretty good. And the risk C is saying risk on. I don't want to be short that on a swing trade. Intraday, there's lots of opportunities. This is a market at all-time highs. It's recovered from this scary sell-off. Peter asks, should we be reducing our positions now? Well, I showed you where my stop was. My stop in the S&P, well, I'll show you when we get to that one. If depending on what time frame you're at and what your objectives are, I can't tell you what that is, but to me, if you're trading long-term stuff like monthly, your stop's got to be right there at 440. I'll keep the whole position on and take my stop. But like I suggested on the swing trade on NVIDIA that we looked at, based on where that trade was in the location, there was no 2-to-1 to the upside. It was stalling where we would expect it to stall. So I make that decision on the basis of the trade that I'm in, and that kind of overrides the market condition. But the market condition right now, in my view, is at a crucial turning point. The last time it was here on a monthly, it failed down to here. We're going to see that reflected on the 9-day. The last time it was here, it sold off hard. So I'm going to be protecting my stops here at 450 if I'm trading with a 9-day bar. 450 is where I think that trade, the stop should be. If I'm looking at weekly, I kind of like maybe the 1 bar low. I might even say the edge of the river around 447. I'm not going to let it go below that. I'm not going to let it come all the way down and test the Bollinger Band mean. Like, that's the least surprising move of all. And if I take the stop here at 447, I've preserved 2/3 of the gains that I just made in here. So reducing your positions should be a function of your time frame, your holdings, what the particular target is, what your goals and objectives are, what your time horizon is, what your risk tolerance is, what your total portfolio heat looks like. All of those things go into making decisions on what to do with the exit for that particular trade. There's no one size fits all on that. That's why I say most of your time should be spent on answering that question based on continuous. I use basically continuous risk and reward. And what is the average length of time that I'm in those positions? And what's the average win on those things? And am I above an average win? Then I want to lock in the average win. Like, if I have an above average win in hand, why would I ever let that go below average? I shouldn't. So those are some of the psychological elements of exit management that we talk about in the hybrid trading course, by the way, at great length. But those are my immediate thoughts. So like this on the 3-day, this one illustrates even more kind of this point. This is testing that previous high. And the last time it was there, it did that in 6 days. It took 4 days to make, or 4 bars to make that move. I'm going to have my stop right here, right? At 452, right below that little 3-day doji. I'm not going to let it go lower than that. If it goes below that, I'm not going to reduce my position. I'm all out because I want to lock in the gains that I've been working hard to get all the way through this little recovery move. Because a move back down to this price level is the least surprising. Heck, a move to the Bollinger Band mean is the least surprising move. So a stop right here protects against the loss of that. That's like preserving against a 3R loss. That's what that, on the daily chart, that's what that 3-bar thing looks like. That's why I say, hey, my stop is going to be like right here, 451-ish. I wouldn't be offended if you picked 452. And that's where I said, actually, I'm looking to get short intraday because I think that this looks like 3 days of stalling after this nice, wonderful move. It's done nothing in the last 3 days but worry. And I think there's a lot of people saying, hey, I'm sure glad I didn't suffer. Even though I lost all that money, I made it all back. I don't want to lose that again. So I think there will be itchy trigger fingers on that. especially as Biden continues to suffer in the polls. All right, drive it on. Blended monthly rebalancing portfolios, real estate, we talked about last week, strong winner. The S&P and the Qs. That's pretty good performance over 1 week on the three things. If we go back and look at the ETF 13 is holding technology, real estate, and the S&P. That ain't bad. And if you had that portfolio, you had those returns this last week, and you take a look at all the other potential returns, you're pretty happy owning those top three strongest ones, wouldn't you? Yeah, you would. And then the other, the ETF 22 owns tech, real estate, and finance. Well, how happy are you with holding those given all the other things that are on the table? You're pretty happy. Yeah, and energy is just its own good trader. I prefer that kind of as a swing trade, but that's in the number one position right now based on the blend. ETF 32, the strong ones continue to be strong. The weak ones continue to suffer. Oh, Brazil and Latin America. So to Ken H's point, you want to talk about a swing position? I'm not going to short the S&P when I can be looking at shorting Brazil and Latin America. That's where I want to be shorting. Now, if the S&P starts rolling over, and then those two are worse, that's easy. That's where you want to be short. But look how bad they are compared to what the S&P has been doing over 1 month and 1 week. So this chart actually, it's this right-hand side that gives us the information for our monthly blended monthly rebalancing. We use the 3-month and the 6-month blended percentage to give us our overall rankings. But while we're here, we can take a look at the 1 week and the 1 month trends to start to see what's really hot and what is really not. Like blended monthly rebalancing would never have you buying those until they've worked their way all the way up the stack. But meanwhile, I can think about value plays, and I can also think about being short on things that are suffering. In the Dow, there's some finance strength, and Goldman Sachs and JP Morgan in 3rd and 4th position. We've been talking about those all week. Microsoft continuing to do pretty well. And then the things that are suffering, so if you want to talk about being short, be short the things that are just getting murdered. Like IBM. And Intel. Oh my goodness. Too easy. Not easy. It's not easy. In the sectors, banks and capital markets, that's finance, real estate, home builders starting to feel it. This might be a chance for some value players to start taking a look at framing some recovery trades in healthcare, XHS. The U.S. is generally doing pretty well compared to the rest of the world. Commodities and oil, because of inflation, are crushing it. Only 3 symbols on a cash position. So if I was, again, Ken H, if I wanted to be short, I'd be looking at emerging markets, Japan, and Latin America. Look at that, is just as bad. Of all the 10 big regions, I mean, that tells you where you want to be looking to be short. And then inside Brazil, Latin America and Brazil in the red. Short the red. Some new strength here in the green and the white. Green and white, that's this line. Shifting to the daily. So close to the new 10-day high, or no channeling it over reactions, but United Health, Pfizer, JP Morgan, Home Depot. You know, Ken H., I think about the short position as I want to see confirmation of disappointment in the underperforming sectors as they are failing in front of my eyes. I like to try to kick them while they're going down, you know. They're brutal that way. So still some good auto framers in position here. Intel just getting slaughtered. Only a couple on the ETFs. Brazil 2.9, Latin America 2.5. They're very suffering is what creates the opportunity for maybe a recovery trade on a tactical time frame. And they're both frog champions, especially Brazil. That's in perfect condition for a frog move intraday. Auto framer, here's the framing data for things that are under or better than 2 to 1. There's your framing data right there. There's Brazil. What do you need? And there's Intel and IBM. That's what it's built-in value plays. And all we're doing is trying to get the recovery. Daily squeezes. There's the Dow 30. There's real estate. That means it's still early days in real estate, fellas. And the S&P is fairly close to the top at 1.8. We're back into the summer. Everyone's happy. So close to the new 10-day high. How quickly it changes. The haves and the have-nots. There's the winners in green, the losers in red. You can ignore the middle. Extreme moves come from the extreme conditions. Either a continuation of the trend, so green continuing to get better, or a reversal of the abnormal trend where the green starts to sell off. The value play is seeing red turn around. So that's why I might be looking at those as potential turnaround plays. I'd like to see evidence of the recovery, but I'll be ready for it. Intel. Ooh. IBM. Ouch. This feels almost like it's stalling to me. That's why I want that stop above 450. You know, like around 452. That's the recovery move. It just made it back to the long-term average. It's now the pause that refreshes. Starting to stall a little bit. It got back to the main. This was the time to make the call, and that's when we made the call. The normal natural turning point. This is where the turning point happened, right here. Because that little doji failed to fail further. And then there is the owl entry. There it is. Would I trade more than one stock at a time? Yes, I would. All the time. Up to 4 in the short-term positions. When I'm first starting out learning this stuff, no, I pick one and master the patterns. Master one with money on it. Or if I'm going to trade 4 and I'm learning how to do it, to learn how to do it with skin in the game, trade 1 share so you have skin in the game and you learn what your span of control is, how many you can manage simultaneously correctly. My span of control is 4 for day trading. Swing trading, I can handle 30. Market mosaic volatility continues to decline. The recovery has gotten back to the long-term normal. It's testing that price top right now. That's the test. The RL30 slope got back to the midpoint. The RL10 is at an extreme. It would not be surprising to see that recover. So that's why I'm harping on where to put the stops. All right, that's everything I got. We'll get this published and posted. Thanks, guys. Tomorrow, 6 p.m. for the Foundations Q&A, 8:30 for the swing trade review, 8:30 in the morning for the coaching crew. I do coaching with my coaching students where we go and do deep dives for their individual trading plans in that little accountability circle that we do on Saturday morning. So that 8:30 for those guys. Okay, that's everything I got. We shall see you tomorrow, and off we go.